The financial system is running on a hallucination. Markets are at record highs, but the foundation underneath them is cracking. The US is treated like the safest borrower on earth, yet it's drowning in debt. The dollar sells stability to the world while quietly exporting inflation back into your life. And if you think this is just a Wall Street problem, it isn't, because the first impact doesn't hit traders. It hits you, your savings, your rent, your grocery bill, your job security. Here's the hard signal. One of the simplest valuation alarms on the planet, US market value compared to the real economy, has now crossed 200%. Another red flag is flashing. The CAPE ratio suggests US stocks are priced about 110% above the long-term norm. People are paying double for the same underlying reality. But here's the part nobody is saying out loud. This isn't just a bubble. It's a transfer of control. And the next move is already being set up right now. Most people think this story is about stocks being expensive, but the core event is bigger and far more structural. Here's the fact pattern from the numbers we already have. US valuations aren't just elevated, they're detached. When the total market rises far above the size of the underlying economy, it's not optimism anymore. It's a pricing regime where belief becomes more valuable than output, and that's why this moment matters, even if you don't own a single share. Because once prices disconnect from reality, the system needs constant fuel to stay standing, not productivity, not wages, fuel, liquidity, confidence, narratives, a steady stream of everything is fine headlines that keep people buying, holding, and ignoring the stress fractures. Now watch how fast this escalates. When valuations stretch this far, there are only two ways the gap closes. Either the economy catches up, which is slow, painful, and rare, or prices reprice down to reality, which is fast, violent, and sudden. So the real question isn't, are we in a bubble? The question is, who benefits from keeping this illusion alive, and what happens the moment it stops working? The strongest claim you can make from these facts is simple. The market isn't being priced like an economy anymore. It's being priced like a belief system. Fact, when the market's value pushes past 200% of GDP, that isn't growth, that's detachment. It means the price of assets is expanding faster than the country's ability to generate real output. And fact, when CAPE signals stocks are about 110% above the historic norm, you're not paying a premium, you're paying a narrative tax. Here's why that detail changes everything. In normal markets, price is anchored by cash flow, earnings, production. In this market, price is anchored by expectation, by the assumption that someone else will pay more later. That's not investing, that's a stability theater until it isn't. Notice what they didn't deny. They didn't deny valuations are extreme. They didn't deny the gap exists. They just keep changing the story around it. This time is different. AI changes everything. The economy is resilient. Rates will fall. Different costumes, same mechanism. And once belief becomes the core asset, the entire system becomes fragile, because belief can flip faster than any balance sheet. Now watch how the story flips. When valuations detach this far from the real economy, the danger isn't just a crash. The danger is normalization. A slow acceptance of prices that don't make sense because people stop asking whether they're real and start asking only whether they're going higher. That's how bubbles survive, not by convincing everyone, by exhausting everyone, by making the abnormal feel routine. A 200% market-to-economy ratio becomes just the new world. A CAPE reading that screams overheating becomes the cost of innovation. And the longer that mindset holds, the more the system builds on top of it. Here's the precedent. Without the textbook tone, when markets start pricing fantasy as if it's fundamentals, the correction doesn't arrive politely. It arrives through a trigger. Sometimes it's rates. Sometimes it's a credit event. Sometimes it's a geopolitical shock. The details change, but the structure is the same. The moment the crowd realizes the floor was confidence, not concrete, the exit becomes a stampede. But here's the part nobody wants to say in real time. By the time you can see the trigger clearly, it's already too late to step aside calmly. Here's where it gets more disturbing. Because the evidence isn't just that prices are stretched, it's that the entire system keeps rewarding the stretch. The market can be far above the economy and still get treated like a safe place to park reality. CAPE can flash that stocks are roughly 110% above normal, and the reflex isn't caution, it's acceleration. People don't slow down, they pile in because they're afraid of being left behind. That contradiction is the proof hit. The warning signs are visible, yet behavior keeps getting more aggressive. And that's not irrational, it's adaptive. In a world where money loses purchasing power quietly, people chase assets because cash feels like decay. In a world where volatility is constant, people chase the illusion of stability. In a world where institutions signal confidence, people stop asking what's under the hood. Notice what they keep doing. While everyone argues about the headline number, they keep selling the idea that the only risk is missing out. That missing out is more dangerous than being wrong. Here's the line that changes the entire story. When fear of missing out becomes stronger than fear of collapse, you don't have a market anymore. You have a pressure chamber. Now the mini crisis stack starts to form, and it happens fast. First, valuations are already stretched past normal limits, which means the system has less shock absorption left. There's no cushion. Second, the entire structure depends on confidence staying steady, because belief is doing the work that fundamentals used to do. And third, the moment a new stress signal appears, anything that forces people to question the story, the repricing pressure doesn't build slowly. It snaps. Because in a market price for perfection, small disappointments don't stay small. A minor crack becomes a major narrative shift. A single unexpected number becomes an uh-oh moment. And once enough people feel it at the same time, the market doesn't drift down, it gaps. But here's the part nobody says out loud. When valuations are this extreme, there are fewer soft landings. The system doesn't de-escalate gracefully. It either keeps levitating or it drops hard enough to reset behavior. So the real tension isn't whether the system is overvalued. That's already on the table. The tension is whether the illusion can keep feeding itself or whether the next trigger forces reality back into the room. Now zoom in, because this is where it stops being abstract. If the system is running on an illusion, you're the one paying for the maintenance. Not with a headline, with your life math. The part of your brain that asks, can I afford next year? Can I move? Can I switch jobs? Can I have kids? Those decisions get harder when the economy feels like a casino with the lights kept on by confidence. When markets float far above the real economy, it reshapes incentives. Companies prioritize stock performance over stability. Hiring becomes cautious even when profits look strong. Prices stay sticky because everyone assumes the cost of money, and the cost of risk can change overnight, and you feel it as noise. Weird bills, sudden spikes, a normal month that doesn't feel normal anymore. The quiet stress of watching essentials creep up while the system tells you everything is fine. But here's the part nobody is saying out loud. The more detached the market becomes, the more ordinary people are forced to gamble just to keep up. Not because they're greedy, because standing still starts to feel like falling behind. If this feels familiar, say so in the comments. Here's the systemic insight that makes this smarter than the usual bubble talk. This isn't just about price, it's about power. When valuations detach from reality, the winners aren't the people who understand the economy best. The winners are the people who can shape belief the longest, because belief is a resource. It can be engineered, managed, reinforced, and the system has incentives to do exactly that. If confidence stays high, assets stay high. If assets stay high, institutions look stable. If institutions look stable, the public stays calm. It's a loop. And the deeper the detachment gets, the more the system depends on spectacle, big stories that keep attention moving forward. A new era, a new technology, a new boom. Anything that helps people ignore the uncomfortable math underneath. Notice what happens in this environment. Risk doesn't disappear. It gets redistributed. It moves away from the people who can hedge it and toward the people who can't, toward workers, renters, families, small businesses. This is where the story flips again. Extreme valuations don't just predict volatility. They expose who really carries the downside when belief finally breaks. So where does this go next? Two paths, and neither is clean. Path one is the slow correction. The economy grows into the valuation gap over time. Output rises, earnings catch up. The 200% market-to-economy signal gradually comes down without panic. That's the optimistic story. It can happen, but it requires patience, stability, and a world that stops throwing shocks long enough for reality to catch up. Path two is the snapback. Prices reprice down to match what the economy can actually support. Not because people suddenly become rational, but because the belief engine stalls. A trigger hits, confidence breaks, and the system remembers gravity. Now watch how fast this escalates. If belief is doing the heavy lifting, then the next move isn't always economic. It can be psychological, a shift in mood, a sudden loss of trust, a moment when the crowd stops asking, how high can it go, and starts asking, who's still holding the risk? And here's the dangerous part. You rarely get warning bells. You get a normal day, then a move, then a new reality. Here's the closing insight you should keep in your head. When the market stops reflecting the economy, it starts reflecting the story people need to believe. And the higher that story pushes valuations past 200% of GDP, past historical norms by 110%, the more fragile the entire structure becomes because it's being held up by confidence instead of concrete. This isn't just about whether prices go up or down. It's about what kind of system we've built. One where belief is treated like a substitute for reality and where the cost of that substitution eventually shows up in everyday life. But here's the part nobody is ready for. The next phase won't announce itself as the end. It will arrive as a new justification, a new reason to ignore the signal, a new push to stay inside the illusion. And that's why you want to be early, not loud. If you want the next layer of this story, the trigger that could flip belief into fear, follow and subscribe, because the next move is already forming and it won't wait for permission.